Something strange happens right before a real commodity market turns volatile. The price on your screen starts telling a different story than the price in the real world. Not a little different. Different enough that professionals stop arguing about charts and start asking one question: where is the metal right now, and who can actually deliver it? That's what this moment feels like in silver. Because a critical split is forming, and it's the kind of split that doesn't stay contained. When the market starts showing signs of a $10 gap between what paper says and what physical demands, between one venue and another, between headline price and real procurement cost, that's when the system shifts from normal trading into something much more urgent: positioning, protection, and scramble behavior. And if you think that sounds exaggerated, let me hit you with the real point in the first 15 seconds. The silver market is small enough that it doesn't take a global apocalypse to break it. It only takes tight availability at the margin, plus one surge in demand industrial, investor, or institutional to force a repricing. The panic doesn't start when everyone agrees there's a problem. It starts when the market quietly realizes the problem is already here, and the price hasn't caught up yet. Now, what do we mean by a critical split? A split is when silver stops being one price, when the market stops acting like a single unified pool and starts acting like multiple pools that don't connect cleanly. One pool is paper silver contracts, futures, ETFs, synthetic exposure. Another pool is physical silver bars, coins, industrial forms, deliverable supply in the right place at the right time. A third pool is location and venue different. Exchanges, different delivery hubs, different inventory realities. In calm markets, these pools stay linked. Arbitrage keeps them honest. Spreads stay tight. Supply moves, money flows. But when a market gets stressed, those links weaken, spreads widen. Delivery becomes the bottleneck. And suddenly the same metal trades at meaningfully different prices depending on where you are and what you need. That is the split that triggers panic mode, because once a gap forms, it tends to attract exactly the kind of behavior that makes the gap worse. Buyers rush to secure supply before it gets more expensive. Sellers hold back because they sense tightness. Middlemen demand higher premiums because the risk of sourcing rises. And speculators smell momentum and pile in, adding fuel to a market that's already tight. So let's talk about this $10 price gap concept in a way that's real and not hype. A $10 gap doesn't have to mean the global spot price is $10 different everywhere in a clean, published way. It often shows up as a combined effect: higher physical premiums, widened spreads between contracts and deliverable metal, regional tightness, and the rising cost of immediate delivery. In other words, the market begins to say, yes, the screen price is X. But if you want real silver now, in size, the price is closer to X plus a painful premium. That premium can move fast when stress hits. And when buyers feel that premium rising, they interpret it as a warning. The real market is tighter than the headline market admits. Now the question becomes, why would this happen now? Why would a split form at all? Because silver is being pulled in two directions at once. On the industrial side, demand is structural. Silver is not optional for a modern economy that is electrifying and digitizing. Solar panels use silver for conductivity and efficiency. EVs and modern vehicles use silver across electronics, sensors, and power management. Data centers and advanced computing require hardware at scale, and silver is embedded in the electrical ecosystem that makes that hardware work. Medical equipment uses silver's antimicrobial properties. Defense and aerospace systems use silver. In advanced electronics and communications, this demand doesn't vanish because consumer sentiment changes. It is tied to long-term infrastructure and production cycles. On the financial side, silver behaves like a pressure gauge for monetary stress. When markets fear inflation, policy mistakes, currency weakness, or financial instability, silver becomes attractive as a hard asset, especially because it's cheaper than gold and can move faster. That volatility is exactly why it's dangerous. In a risk-on environment, silver can drift and frustrate. In a stressed environment, it can snap and surge. When both forces collide, industrial pull plus financial hedging, silver doesn't just rise, it can become disorderly. And that disorder is what creates splits. Now let's talk about the mechanics of how a split forms, because this is the high-value part most people never get. In a normal market, the paper market can be huge because most contracts are cash-settled or rolled. Few participants demand delivery. This allows paper volumes to dwarf physical volumes without causing immediate strain. But the moment more players start caring about delivery, whether because they're industrial buyers securing supply or investors seeking physical protection, the system gets tested. Deliverable inventory matters. Logistics matter. Refining matters. Warehouse stocks matter. The market stops being infinite liquidity and starts being available inventory. That's when the gap can widen quickly, because paper can still trade freely even while physical gets tight. The screen says one price, the physical channel says another. And here's where panic mode becomes rational, not emotional. You are an industrial buyer and you need silver for production. You don't care if the paper market says the price is lower. You care whether you can source metal reliably. If you suspect supply is tightening, you lock in contracts early. You pay up, you build inventory. This is the same behavior we've seen in other supply chain stress periods. Companies shift from just-in-time to just-in-case. That shift itself accelerates the problem because it pulls future demand into the present. If you are a bank or a large intermediary, your fear is different. You fear being short physical metal in a market that suddenly demands physical delivery. You fear a squeeze, not just a price squeeze, but an availability squeeze. That's when institutions tighten terms, reduce lending of metal, and hold inventory more tightly. Again, those actions tighten the market further. If you are a speculator, you see widening spreads as opportunity. You try to arbitrage. You buy in one place and sell in another. But when logistics and delivery constraints are the real bottleneck, arbitrage isn't as easy as it looks. In stressed commodity markets, risk-free arbitrage becomes risk-full arbitrage because you can't assume smooth delivery, smooth financing, or smooth timing. That's why gaps can persist longer than people expect. Now, what does a $10 gap actually do to price behavior? It changes the rhythm. It turns silver into a market that moves in steps instead of trends. The market stops politely climbing and starts jumping between ranges. Pullbacks become shorter and sharper because buyers are reacting to availability. Breakouts become faster because once a level breaks, the next liquidity pocket may be thin. And volatility becomes the story because volatility is what flushes out weak hands and forces repositioning. This is why when a split forms, it can trigger a feedback loop. Premiums rise gives buyers rush to secure supply, gives inventories tighten, gives sellers hold back, gives premiums rise further, gives paper traders chase the move, gives price spikes, gives more attention, arrives gives more demand, hits gives spreads. Widen again. That loop is how quiet tightness becomes visible panic. Now let's address the key skeptical question. If silver is so important, why isn't the market already priced like it's critical? Because markets can ignore slow structural shifts for years, especially when the story isn't fashionable and the pricing mechanism is dominated by paper. The market can remain calm until the moment it's forced to acknowledge physical constraint, and the forcing function is almost always the same. The system runs out of slack. Slack comes from inventories. Slack comes from refiners being able to meet demand quickly. Slack comes from holders being willing to sell. Slack comes from consumers being price sensitive. When slack shrinks, small shocks create big moves. And here's the thing about silver specifically. Silver's supply response is slow. New mines take years. Many silver ounces come as byproduct production, or grades decline. Costs rise. Recycling is limited because silver is dispersed across products in tiny amounts. That means when demand accelerates, supply doesn't catch up next quarter. Its strains now bring this back to America, because your audience is US viewers who care about what it means for them. If silver enters a split-driven panic mode, it's not just a metal story. It becomes a signal about the broader system. A widening spread suggests friction in supply chains, stress in commodity financing, and a shift in risk sentiment. It can feed into inflation narratives because silver is embedded in goods and infrastructure. It can amplify concerns about monetary stability because metals become attractive when confidence wobbles, and it can impact equity markets in sectors exposed to input cost manufacturing. Renewables, electronics because margins get pressured, but the biggest impact is psychological. When markets start treating a strategic industrial metal like an insurance asset, investors begin asking what they're missing in other markets. That's when contagion can happen, not necessarily in prices, but in sentiment. Now let's talk about what comes next, the sequence that tends to follow. A developing split. First, you see a period of confusing price action. Silver might surge, then pull back, then surge again. Commentators call it manipulation or noise. But underneath, the spread behavior tells the truth. Premiums stay elevated. Delivery feels tight. Availability is not improving. Second, you see institutional behavior change. Banks and dealers become more cautious. Industrial buyers lock in contracts earlier. Large holders stop being casual sellers. The market becomes less liquid at key moments. Third, you get the trigger day. It might be a macro print and inflation surprise, a rates repricing. It might be a geopolitical escalation that pushes safe haven demand. It might be a supply disruption. It might be a sudden wave of investment demand. In a tight market, it doesn't take much, but when it hits, price moves become discontinuous jumps, gaps, sharp range expansion. Fourth, the story flips. Media and investors who ignored silver suddenly chase it. That attention adds more demand at exactly the wrong time, accelerating the move. And here is the most important warning inside this entire story. When markets enter panic mode, they don't move in a straight line. They move in violent waves. The people who get hurt are usually the ones who think they can time every wiggle. The people who benefit are usually the ones who understood the structural setup early. Tightening physical availability plus accelerating demand equals repricing. Risk. So what should the viewer watch for if they want to know whether the split is real and getting worse? Watch behavior, not commentary. Watch whether the physical market stays firm even when paper price dips. Watch whether premiums remain elevated. Watch whether large buyers are securing supply earlier. Watch whether institutions behave defensively. Terms reducing availability, holding metal more tightly. Those are the signs that the split is not a headline, it's a condition. Because once a market begins splitting into multiple prices, it is telling you something fundamental. The system is no longer confident it can deliver smoothly. And if you stay with me to the end, here's the final piece, the part that makes the $10 gap truly dangerous. In a normal market, price tells the truth. In a split market, availability tells the truth. And when availability becomes the truth, price doesn't climb, it leaps to re-establish balance. That's why splits don't resolve gently. They resolve through either a surge in supply, a collapse in demand, or a repricing sharp enough to force behavior to change. If demand is structural and supply is slow, the market's most likely tool is repricing. That's what panic mode really means. Not fear, not drama. A market being forced to correct an illusion. The illusion that silver is abundant, liquid, and easy to source at scale whenever the world wants it. And when that illusion breaks, the move that follows is rarely slow enough for everyone to adjust comfortably. So, the real question isn't whether silver is bullish. The real question is if the market is splitting into multiple prices. Who is prepared for what happens when the price on the screen finally has to catch up to the price in reality?